Hey folks, this is the Contrarian Trader. Yesterday on my Contrarian commentary, I mentioned that watch out for the July 16th CPI data, which was set to be released and was released this morning. Due to the fact that a couple of weeks ago we had stronger than expected average hourly earnings. And again, as an American, glad to see it. I like to see my fellow Americans making money. However, the Federal Reserve sees it differently. They see it as inflationary. So it's good to have a little bit of inflation in the average hourly earnings. However, not too much, and keep an eye on other prices. Fast forward to last week, and we saw a breakout in oil prices on a monthly chart. I shared that with my members on the week ahead commentary over the weekend. Last week as well, the producer price index is a measure of goods, cost of goods produced at the producer level, came in hotter than expected. Market expectation of 0.3, actual was 0.8. That was released on the 12th. Fast forward, and again, I mentioned this last evening, keep an eye on the CPI. Let's see whether or not you're getting a pass-through to the consumer. Why is that important? It's important due to the fact that the Federal Reserve has had a mandate to keep its foot to the gas pedal on buying bonds, printing money, as long as you do not see inflationary pressures in the economy. That is beginning to change. You're beginning to see interest rates spike higher. You're seeing energy prices spike higher, and that's absent a growing global economy. China's pulling back. Europe's in a recession. I mean, not even a recession, a depression. South America's pulled back. They're in a recession. Most of those countries. Australia is a mess. So CPI came out today. Market expectation of 0.3%. Actual was 0.5%. Driven by what? Energy and food. What, of course, does the Federal Reserve back out of their core number, which is how they measure inflation? They back out food and energy. How convenient. Market expectation 0.2. Actual was 0.2. So according to the Federal Reserve, they don't see a problem with inflation. However, we in the real world are getting hammered to death. And you're seeing it impact retail sales. And they had better be concerned about a slowdown in retail sales. Remember yesterday you had market expectation of a 0.7% increase. Actual was 0.4. I got an email yesterday. What do you mean by silly season? We're in silly season. I call earnings silly season due to the fact that it gives companies an opportunity to BS the American public about how good they're doing. Then CNBC comes out and they're able to announce that XYZ company beat by a penny. They beat on earnings. They try to get everybody excited. Pre-market, it is in the case of Goldman Sachs, it spiked higher this morning. What did it do? It closed down. Take a look at this chart. I shared this with my members over the weekend as we prepared for the coming trading week. This is a 5-year chart. S&P 500, negative and positive pre-announcements. In red are your negative pre-announcements. Take a look at how high they are spiking pre-announcements, and take a look at green, how positive pre-announcements are just dropping off of a cliff. My guess is that what they're trying to do is they're trying to lower the yardstick, lower the bar, so that they can come out on earnings day and beat by lowered expectations. Now, if you take a look at CNBC viewership since 2004, it is just dropping off of a cliff. Their viewership is in total chaos. So what they need is they need to get people engaged again in this market, but it's not happening because people just don't trust the market anymore. I think it's the greatest thing since sliced bread, the stock market, but you need to know how to trade it. All right, let's take a look at some of the charts, the transports. Be careful of a breakout. This is a weekly chart. Be careful of a breakout on the transports, because if the Dow Jones breaks out, if they're manipulated higher, yet you do not have a breakout, and I'm not seeing it here on the transports, the probability of a breakout in the transports is passing every given day. You have to put a rally of the Dow Jones in question. Remember, UPS last week warned, lowered forecast, and got hammered for it. You're seeing topping tails 2 weeks in a row so far. Yes, it's only Tuesday, and this could all change. We can close above 65, 68 for all I know by the end of the week. However, the way the week is setting up right now is not a bullish setup for the transports. Let's move on. S&P 500. Earnings is supposed to be great. What happened? Coca-Cola came out, bad earnings. Goldman came out, not so good, exciting earnings. And the S&P 500 pulled back today. Not a big pullback, 0.37%. Let's not get all excited. A little bit of a bottoming tail. They're not going to let it drop yet. Far too early into earnings season to let the markets just drop. Volume very, very low on the S&P 500. So nothing to get all that concerned about. IWM, a little bit more concerning. I mentioned this one yesterday due to the fact that we had broken out above. I mentioned draw a trend line up. We were pushing the upper band of the rising uptrend channel. Expect a pullback. And sure enough, today we had a bearish engulfing. The saving grace was that volume was very light. I mean, yes, it came in higher than Monday's volume, but still quite light. I don't expect IWM just to fall apart. Not quite yet. XLF, the banks. I mean, let's face it. Earnings are supposed to be great. The banks are supposed to be great. XLF, daily chart today, down by almost 0.4%. Light volume, though. Can't go shorting the banks just yet. I mentioned this chart yesterday. The HGX, the housing index. They attempted to rally it higher today. I am warning everyone that's watching this video. If you see the HGX this week on a weekly chart break back down below this prior resistance level, or now what should be a support level, you are going to see havoc in the housing sector and probably havoc in this economy, because the Federal Reserve would have failed. If the housing sector breaks down to new lows below the 168 level and they keep policy unchanged, they would have failed in their efforts to raise housing prices, raise the wealth effect by homeowners with their insane $85 billion per month of monetization of our own debt. Let's take a quick look at the VIX weekly chart. It's only Tuesday at the close, but we're up by about 4.5%, a little over 4.5% on the week thus far. Nothing to write home about. Early in the week, just keep an eye on it. Let's do a tour down memory lane so far. Are the banks, the earnings season thus far? JP Morgan reported earnings last week. We're right back to pre-earnings announcement prices on JP Morgan's. And right now, this is looking as if it's best of breed. Wells Fargo, bearish engulfing today. I wouldn't put all that much more money into Wells Fargo, down a little over 0.75% on volume. That's not that exciting. It was below average, so I wouldn't go shorting it. However, I would just keep it as a watch right now if you're looking to buy a bank. Citigroup, they reported. They closed up on the day. They are the superstars. I'm taking a look at volume here. Volume was below average, below Monday's volume, about average with their average daily volume. So it doesn't look as if Citigroup is going to fall apart anytime soon. However, we're right at a resistance. I would not be buying it. The ideal situation, you want to buy Citi, which I wouldn't. Let it flag out on light volume, then pick some up. Just keep an eye on the underlying sector, the XLF. Make sure that's holding up as well. Goldman Sachs, they had this spiked up in the pre-market. They had it spiked up at the open, bearish engulfing. This is one but ugly chart. Not good at all. Watch out for potential lower high on Goldman and draw your trend line here. You draw your support, 148.71. You see a breakdown below that level, you're going down to the 130s, and you're probably going to see, at a minimum, the 200-day moving average. And last chart, folks, is AETI. We traded AETI. This is one of our best stock picks. And we took profits today. We opened up the trade yesterday. I'm going to do a video on how we traded this. We opened it up yesterday in the final few minutes of the close, and we took profits at 1 o'clock today. and booked a nice 4.2% profit on the trade. And good trade. I'm going to do a video on that as well. Tesla, we are short of Tesla. I'll go over that trade as well, but it's way too late to get short of the stock. So I'll go over that trade as well. So if you want to get my trade alerts, please sign up for the 14-day free trial offer. And if you have any questions, please shoot me an email. I don't want anybody to lose money. Robert the Contrarian Trader. If you're watching this on YouTube, please subscribe to my channel. If you're watching this on Twitter, StockTwits, however you could sign up and get my alerts, or if you're on the home page, sign up for my newsletter and you'll get alerted when I do a new video as well. Just subscribe to whatever I'm on. I'm on so many things now that keep me on. That's it, folks. I will talk to you soon. Take care, folks. Bye-bye.